following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there had a great trading week. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And I am joined on the show today by, of course, my counterpart, the yin to my yang, the man who keeps me grounded in the world of volatility, good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the show.
Good to be here. We took a week off last week, but heard a very interesting show.
Maybe you did. Some of us were still working, Mr.
Sorry to
Lazy
use that
Pants.
Royal we. I took a week off last week while you guys toiled away. Had a very interesting guest. We might talk a little bit about some of his findings a little later in the show, but our CEO, Bob Krause, ably stepped in, as he often does. So I thank him for stopping by, and I'm happy to be back.
Yeah, while you were relaxing on the sun deck, Bob and I were knee-deep in the world of tail risk, and it was an intriguing discussion, to say the least.
So I heard.
And, of course, we are also joined today by the man from the pit, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, welcome back to the show.
Hey, I love being here. I would never miss a Volatility Views, although I do miss them sometimes.
You do miss them sometimes, but you endeavor to be on whenever possible. All right.
Well, the being in Don's warm glow makes me happy.
He is just quite the warm, fuzzy character, isn't he?
He is.
He brings a smile to all and sundry, particularly children. They just bond with him for some reason.
They love there's Don. Don takes a backseat maybe to Santa among children. That's about it.
When my little guy gets grumpy, I just turn on a recording of Vol Views, and Don's voice just cheers him up right away. It's amazing how that works.
Oh, for sure. For sure.
You found yet another use for Volatility Views right here, listeners. Calming, crying children. All right.
There you go. It's like running a vacuum cleaner.
All right. And with our team assembled, we're going to dive right into the Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we discuss the action in the world of volatility over the past week. And it has been an intriguing week. That VIX just can't seem to stay afloat these days. More sellers than buyers, as the old-timers used to say to me on the floor whenever I asked why something was down. And I think that is definitely the story these days in VIX, at least for the foreseeable future. What have you been watching over there from a volatility perspective, Mr. Sebastian?
Well, they're destroying the VIX. They're destroying volatility, and as they should. I wrote something up that might end up on Mad Money on Friday, basically pointing out that the VIX is below 20, but do you know what volatility the S&P is actually trading with? I mean, it's unbelievably low. The VIX is trading at a massive premium to realized volatility. I think Don can back me up on that one.
That's the way it would appear, yes.
Exactly.
But yeah, that's we had your cohort here, Andrew, on the Option Block show yesterday, I believe it was, and he was saying that he thinks VIX is going to be south of 20 for some time to come in the foreseeable future. And I can't say, given all that we've been seeing unfolding lately, I can't say I disagree with him.
I couldn't agree more. I think we're going to see VIX below 20. This is, that the whole futures roll yield in VIX futures is going to start being the play of the fun play again, and all those little ETNs that everybody loves to hate are going to be just beautiful sales. I'm a little annoyed that I don't have an extra 2 weeks in expiration because I was holding some 25 puts in VXX that I think are going to hit 2 weeks from now, not today, unfortunately.
That's why we need some VIX weeklies to expand that that portfolio of options.
It'd be interesting. You'd have options on VIX you'd have weekly options on VIX, and on a product that actually does not take weekly options into account when it's calculating its volatility. What do you think about that? Kind of interesting.
It would be the irony of all ironies.
The irony. What I think the SIBO needs to do is kind of adjust how they calculate the VIX, or come up with a weekly VIX. Like a short-term VIX, something like that I think would really be an interesting little product.
Yeah, given the settlements we've seen recently, what's your take on the most recent settlement there on the VIX?
I think we wrote this up on the blog. It's incredible that on Wednesday they managed to print the VIX over 23.5, and in 1.5 days from then we're now trading below 20. So I'm not saying, I'm just saying.
According to those who know, it was ostensibly those who know, it was some large resting order that went unnoticed in the book that apparently caused that aberrant settlement. And,
I'm sure that was
it wasn't someone buying the 500 puts or all the other crazy things we've seen.
I remember before they printed the settle, like first thing in the morning, I was like, boy, this skew is really expensive in SPX. And then it
was settlement skew. That's what it was. Yeah. All those bids were coming in.
You could 1 by 2 out a lot of things. Then, by 9 o'clock, it had settled. The skew came in. The 10 Delta put was trading at about 155% premium to at the money at 840, and by noon it was trading at like 138%. And as Don will tell you, that squaring function. If you were gonna mess with the VIX, I think that puts would be some of the money puts in below the 10 Delta would be where you'd want to do it.
Yeah, that's where a lot of the quote unquote intriguing paper tends to come in around settlement that causes all sorts of fun things. And at the end of the day, regardless of whether the VIX is settled or not, there certainly is or settled improperly or not, or manipulated or not, there certainly is a perception issue around it that needs to be addressed, I would think, because any of the informed users of that product are certainly not happy with the way it's been settling. And
exactly.
And it certainly gives the appearance that something is going on behind the scenes.
Even if it's not.
Exactly. So that is a problem in and of itself.
The settles have been getting better, and then this happens.
Yeah, the last two in a row or so have not exactly knocked it out of the park, let's say.
No.
All right, thank you for that, Mr. Sebastian. And of course, we cover the broad spectrum of volatility here on Volatility Views, and that includes the Euro Vol and hopefully in the not too distant future the NASDAQ Vol, but we'll settle for the Euro Vol right now. So Don, what's been going on in the land of Euro Vol for the past week?
A little bit of an increase, and I'll give Bob his props. I know you asked him in the crystal ball segment for an outlook for the week to come.
I think his cogent analysis was it's going up.
He said, since I usually take the downside, he'll take the upside. And I checked just before the show, and the Thursday settlement before your Friday taping was 11:33. And the Thursday settlement last night was 1168. And although it's not a big increase, it certainly is up. So we'll put a check mark in his column there.
It works for our purposes.
Called it correctly. And a little bit later, we'll talk about what we might see for the following week. As of right now, we've got about 2 weeks to go in the front month, February 1 vol contract. And of course, a bit longer with the 3-month quarterly. The March doesn't expire for another 2 months or so, but we'll take a look a little later at what the actual accumulated or partial realized volatility is in those contracts, what the Volatility Institute and our friends over there are forecasting for future realized volatility and see if we can't put that all together towards the end of the show.
All right. We're looking forward to that as well. Yet another tease, Don. You're getting good at this radio thing. Leaving teases for our listeners now, so they'll be hovering over their iPods or their smartphone / media player of choice to
foreshadowing of things to come.
Exactly.
Stay tuned.
Exactly. All right. And that's going to do it for our volatility review. And now we're going to dive right into our volatility viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint. This is the portion of the show where we bring on a guest, or sometimes Don and I bicker amongst ourselves about what's going on in the world of...
Today, so you just have to settle for us.
Yes, exactly. We can't bring the world beaters on every episode. You know, sometimes they have to settle for us. But yes, in this episode, or this segment of the Volatility Viewpoint, since Don wasn't on the previous show, didn't have a chance to discuss some of the topics we discussed last week. I'm going to give Don his chance to chime in on his 2 cents on last week's episode. And of course, last week's episode, if you didn't listen to it, listeners, you have to go back and listen to it. We had Nikunj Kapadia. He is the associate professor at the UMass Eisenberg School of Management, and he's done some very interesting studies on tail risk and the VIX, as well as a number of other derivatives concepts, including buy rights, and you name it. UMass has really become the mecca for a lot of derivatives research these days. I know the OIC does a lot of their studies there. The buy rights and collars all come out of that UMass center. So UMass has really become the place for studies on a lot of actually practical elements of derivatives, which I think is interesting, as well as some of the more esoteric things like some of the tail risk things. But you also see the buy rights and the calendar, and the collars. And yeah, last week was a very fascinating show. And before I even get into that, let me just step back for a second and say just how great it is on just on a cerebral level and on an interesting level to see that Vol Views has just become this forum where everyone, these academics from all over the world, literally all over the globe, and their theories spanning all elements of volatility, this is the place where they can come and discuss their theories, and we can give them some back and forth. I think that's just been a fantastic development for our show, and I know our listeners have loved it. We've had just a fantastic roster of guests that if you are at all intrigued by any aspect of volatility, I can guarantee you that there is someone in one of these shows we've had recently that will say something that will be of interest to you. And we've run the gamut from technical analysis of volatility to now in a more recent show we had, of course, the tail risk. We've had guests like Robert Engel, and just running the gamut across volatility research and analysis and trading. It's been a fascinating journey for me alone, let alone I'm sure for most of our listeners. So I'm looking forward to seeing what we cook up next on this show, because it's been fantastic so far. I'm pretty excited by the roster of guests, and I'm sure you are as well, Don.
I've been enjoying along with you, Mark, and we actually have 2 more coming up in the next 2 weeks. We'll provide a few more details as time goes on, but next week and the following, we have 2 other distinguished guests who have done great things in volatility studies. So I think we're going to just keep trying to keep them coming and have these stimulating conversations such as the ones that you have mentioned.
Maybe we'll have to try to do something down the road where we bring them all back at once for one epic volatility roundtable. That would be a discussion worth hearing, I think, if we can get anyone to be heard amongst the cacophony of opinions.
Yeah, we have to have like an annual reunion, put everybody in the same room, and just duke it out to the finish.
I like it. But if our listeners did miss the previous episode, I encourage you right now to pause your player of choice and go back and listen to that episode. But of course, if you did miss it, Nikunj discussed a number of different elements of tail risk and how it applies to the VIX and some of his findings on that front. And I think Bob and I were both very surprised by one of his findings in particular, and we discussed it at length on the last show, which is he found in his model that VIX didn't properly measure or gauge the level of tail risk, particularly when you're talking about tail risk in the downside puts here on the SPX. That is where we see the bulk of the tail risk premium being priced into the skew curve. And what surprised us, perhaps I know surprised Bob, but it certainly surprised me, was when his finding that it wasn't what you might assume, which is that tail risk is maybe priced in too often and too frequently. It was actually the opposite, that when you factor in the tail risk for some of these extreme events like we saw in 2007, these quote unquote black swan type of events, then that the VIX actually fails and underprices on the tail risk aspect and actually underprices these puts. And that, I think, that certainly surprised me, and I'm sure just given some of the feedback we've seen when people listen to the show, that surprised a lot of our listeners as well. And Don, I think you fall into that camp as well. Am I correct?
Well, here's my take on it. And, you sometimes see studies and you have to kind of look at them for what they purport to be. And if I understand the research and I understand the goal of what Nikunj did, see if I can add my own spin to it and put it in perspective. Summarizing what he said last week was simply that we know that VIX has a certain weighting for all of the options that it uses to come out with this one single number, this index. And we know that there's an inverse square relationship to the strike prices, so that as we go farther down to the out-of-the-money puts, that's a lower number, and therefore it carries more weight because of the inverse factor than a higher strike option would. Of course, that's mitigated somewhat by the fact that they use the prices of the options, and the out-of-the-money options, the puts, have very low prices because some of them are so far out of the money. But it all goes into the mix, and you come out with a number, and we call that number VIX. And one of the things that it does is it gives an overall averaging or a blending of the implied volatilities up and down the spectrum from the lowest strike to the highest with this weighting that we've discussed. And Nikunj said that there are other ways that you could weight those implied volatilities. VIX does it one way. You could crunch those numbers any way you like. And he mentioned that instead of squaring individually and then averaging, what he did was actually add first and then square later. Well, when you do that, you inevitably get a much larger number. Let's take 1, 2, 3. If you square 1, you get 1. If you square 2, you get 4, so we're up to 5. And if you square 3, you get 9, so we're up to 14. And if you average those three numbers, 14 divided by 3, you get 4 2/3. And, you could do with that whatever you want. Well, if instead you add them first, 1 plus 2 plus 3, okay, now we're up to 6. And you square that, and you get 36, and then you divide by 3, and you get 12. You get a much bigger number. So he's simply saying that he decided to crunch all of the implied volatilities and to weight them in a different manner than VIX does, which, of course, is his prerogative. And why is he apparently doing that? Because his number, the larger number, will be closer to volatility that is manifested if we have some sort of a crash or a black swan or a catastrophic downside event. And he specifically said it was to the downside because he did not study upside tail risk or anything having to do with upside events, only the downside events. And of course, you can't really fault that. Well, he's absolutely right. If the market crashes and drops 15, 20% today and volatility spikes to 80% or something like that, you would have wanted to have a number that was a lot higher than what VIX is today in order to predict something like that. But, at what cost and at what price? If you want to use a number like that for any kind of a daily assessment of volatility, then I guess to my way of thinking, it's a little bit like, a stopped clock is right twice a day, but it's all wrong all the rest of the time.
Yeah, what do you do with the rest of those data points out there, which are
you want to use
legion.
that huge number, and you want it to be anything meaningful for all the normal days that we have, which is most of the time. It's not going to do a heck of a good job of being terribly meaningful for that. And so, to play the devil's advocate, the answer could be, well, it's not intended to be meaningful for that. It's only intended to be meaningful, if we have a black swan event. Well, that may be true, but I just don't know how much you can really do with all of it.
Yeah, that's actually kind of what I was trying to get at when I asked him, you have this quote unquote superior measure of tail risk. You have this new tail risk index. What do you plan to do with it? What have you done with it? Have you licensed it as a product? Are you looking to go that way? And no fault to him, as any typical academic probably would respond. He hadn't thought of that far. He had created the index. He had found his empirical findings that he thought were interesting, and they were indeed very surprising to us. But it usually doesn't proceed much beyond that point with a lot of these studies.
And of course, the only other point, in fairness to him, he didn't claim otherwise, and that was he wasn't really trying to look at any of the data and use it in a manner that would predict on his own a different implied volatility for the out-of-the-money options. He actually said, if that implied volatility is not already there in the options, there's nothing I can do about it. So if he looks at a 30 implied volatility for a way out of the money put option on the S&P, he isn't going to look at that and say, I'm going to change that number to something else. He accepts whatever the market is pricing those options at from an implied volatility standpoint. It's only that he's then using that same number and massaging the data and using a different algorithm to come up with this tail risk measure or this index or this number that turns out to be greater than what the VIX number is. But it's got to kind of be in the options to start with. He's not trying to actually price those options in a different manner, and he made that very clear.
Yeah, that's interesting, because then at that point, then the inherent gut reaction to this when you first hear this conclusion is, oh, well, buy all of that tail risk. It's obviously deeply, dramatically underpriced. And yet when you look at it a little more, like you said, he is using the current levels of volatility in the market and just looking at them in a little bit different way. So he probably wouldn't really technically be a buyer or seller at these levels. He's just looking at more of a cursory analysis. Of course, we all know from practical experience that if he was a long-term buyer of tail risk in this fashion, I don't think it would be the most long-term profitable trading strategy, unless we had another quote-unquote black swan event in the immediate near term that paid for all of the rest of his trading.
And that, I think, maybe is the takeaway and the bottom line, and that is it's hard to say just what you would suggest doing with this, because I don't know if he wants us to come away with this conclusion or not, so I'm not certainly putting words in his mouth. But if the conclusion that was implied, no pun intended, was that we should actually look at these out-of-the-money options as if they ought to be even more expensive still, well, good luck in offering them out there and seeing if anybody wants to buy them. The market ultimately tells us what the price of something should be. And if the whole world is missing this and they ought to be more expensive still, then, as you say, there ought to be some sort of strategy or arbitrage in which you could potentially buy these options on the cheap, as it were, and possibly come out ahead. But I'm not sure that he's got any data that would substantiate such a claim.
No, and I'm sure he would find an infinite number of sellers to satiate his buying needs were he deciding to go down that path.
And I think I'd be on that line somewhere.
Somehow I knew you would fall into that camp, Don. I don't see you gobbling up a lot of downside puts in your near future in any way, shape, or form. It would be interesting. I didn't have a chance to ask him on the last show. If we do have him back, it'd be interesting to see what he thinks of the CBOE's recent endeavors to quantify that quote-unquote tail risk with their skew index now. And, we've discussed it on the show in the past. It is a little bit obtuse, the way they calculate it, the way they disseminate it. They only calculate it once a day, so it's not of much utility to the end user right now. But it would be interesting to see if he quantified his own skew index, Nikunj that is, how it would compare to what the CBOE is disseminating as the quote-unquote measure of skewness or tail risk that the market is currently pricing in. I'm guessing off the top of my head that he would his number would be a wee bit higher than what the CBOE is disseminating.
That's the way it would appear, yes.
Well, I'm glad we had a chance to bring that up here, Don, because I know you were chomping at the bit. Since you did have your vacation last week, you'd missed your chance to jump in at this juicy discussion. So I thought I would give you a chance to chime in now. And that is going to do it for our Volatility Viewpoint segment. And now we're going to dive right into our listener mail segment.
Listeners write in.
Mail's in.
Mailbox.
And welcome to the Mailbag. This is the part of the show, one of my personal favorites, where Don and I open up the old mailbag and we peer within to see what our listeners have in store for us. And not surprisingly, Bob's little mention at the end of the show last week that there may be some new products in store in terms of realized volatility coming up on the NASDAQ, that really set off a response amongst our listeners. And as I expected, a lot of them are very surprised, and one of them has some interesting questions, and I think that leads to an interesting conversation about how these products will be structured and will perform going forward. So we'll start off with the first one that was posted on our forum today. He's a very excited poster here, goes by the handle Athos, who is indeed my favorite musketeer, so I like that name. And the title of his post is Vol Contracts on the NASDAQ! Exclamation point, exclamation point, exclamation point. So
yeah, we get three. That's
yes, three. He's an excited fellow, and he says, woohoo! Exclamation point, exclamation point, exclamation point. So he's definitely excited. He says, this is what I've been waiting for, a realized vol contract on an underlying that I actually trade. This is going to open up a whole new world of trading possibilities for me. I can't wait to short VXN and buy the realized NASDAQ product. I won't need to wait for Don to earn me an island in the Bahamas. I'll pick one up myself when I collect all of that juicy risk premium. In all seriousness, I couldn't be more excited by this announcement. This will be an enormous development for VolX, as well as for all of the realized vol aficionados out there. As the book says, we are legion. So thank you for that, Athos, and your sentiment was echoed by others out there. It's definitely an exciting time, and it's certainly a sentiment we've been receiving on this show almost from the first episode. We love the concept. We just wish it was on a product that is more in our ballpark, aside from the euro, and the NASDAQ seems to fit into the wheelhouse of a lot of our listeners. And I do hate to burst your bubble there, Athos, but VXN, you might have to be waiting a little while for that trade to come to fruition, because first you have to wait for the realized contracts to come online, then you have to wait for the CBOE to list an actual contract on VXN that you could short, and then you'd be all set. Then you'd have that dream trade that you were speaking of. But in the meantime, it's very theoretically enticing. Would you agree, Don?
I just he shouldn't pack the suitcase with the suntan lotion for the island yet, but we're warming up to it. So obviously the ability to start to trade our realized volatility products on equity indices, and we're proud to be associated with NASDAQ, we hope is really going to open the door for a great many more people to trade the product and to become familiar with how it does trade, what similarities and particularly what differences there are with an implied volatility product such as VIX futures or ETNs. And I'm sure that in the weeks to come, we'll have many, many discussions about the equity side of things, the fact that there's seemingly inverse correlation between equity prices and volatility, but that isn't always respected. And so sometimes the two diverge and sometimes they don't. And lots of good things to discuss in that domain.
Oh, yes, there's quite a bit of. I'm looking forward to all the topics we'll have to discuss now once this second tier of products launches, and we could really dive into the meat of those products. And speaking of those products, we had yet another person writing in about them. This one via email from Tom Cragston here. I believe that's how you pronounce that, in Philadelphia, and he writes about options on NASDAQ Vol Contracts, and he says, on the last show, Bob Krause, announced that VolX is planning to launch Vol Contracts on the NASDAQ. He also said that you plan to launch the full suite of products on the NASDAQ Vol Contracts, including options. Now, correct me if I'm wrong, but wouldn't the options be priced on an implied volatility basis? So essentially, you'd have an implied volatility instrument trading off a realized volatility instrument. That is an intriguing scenario, but the inherent contradiction makes my brain hurt whenever I think about it for too long. Well, Tom, I'm sorry we made your brain hurt, but you're right. It is an intriguing notion, and I'm glad it's one you picked up on, because it will be interesting to see once these products start listing and how people do start pricing that implied off the realized, and vice versa. I think there's going to be a lot of room for some interesting trading back and forth and some interesting arbing back and forth with those two. Would you agree, Don?
Yeah, and I think what we need to point out so that all listeners can kind of wrap their head around this, and that is options, one of the inputs is a certain assumption of volatility. And when we back that out of the price of the option, we call that the implied volatility of the option.
Yeah, there's no getting away from that.
Yeah, and we've spoken for a long time about the fact that, at least in the equity world, the difference between that implied volatility of the option and what actual or realized volatility goes on to be is often different. The implieds are often higher by a certain amount, 3-4% historically. And for a number of reasons, a risk premium, sellers having open-ended risk, and other factors that we've discussed many times on the show before. But you mustn't therefore be put off or wonder about how you could have implied volatility of an option with a realized volatility product. The fact as to what the underlying is of the option is actually irrelevant in a sense. The underlying can be anything whatsoever at all. And of course, it sounds a little bit funny that the underlying is volatility itself, is realized volatility, because now if we speak about the volatility of that, we have this volatility of volatility phrase that people start to get a little bit confused about. But just think about the fact that any underlying asset that moves, that has a price that you can measure every day, no matter what it is, could be wheat, gold, corn, the S&P 500 index, or this thing called realized volatility, has a volatility of its own price movement. And so there's really no contradiction. There's really nothing to be upset about, that the underlying will be realized volatility, and that when options trade on that, they will trade and be priced in a manner that somebody's going to put an implied volatility to those options. Now, what becomes very interesting is what those implied volatilities may be for an equity index such as NASDAQ or S&P or Russell or whatever the case may be. And I think we've mentioned many times on the show before that this is the part that becomes very fascinating, because whereas when you look at the underlying cash index itself and you look at the volatility of the cash movement, it doesn't make a heck of a lot of difference if you take a look at long-term averages, whether you look at a 1 month, a 3 month, or a 12-month volatility. They're all very close. I actually pulled up the NASDAQ over the last 5 or 6 years, and the average volatility of the price index, the cash index itself, was 20.3 for 1 month, 20.9 for 3 months, and 21.5 for 1 year volatility. So no matter what time frame you use to assess the historical volatility of the NASDAQ, you're looking at a 20 or a 21 figure. On the other hand, if you want to take a look at the volatility of that volatility, how the 1 month volatility jumps around, how the 3 month jumps around, or how the 12 month doesn't jump around all that much, you get tremendously different numbers. And all of this is on our website in our historical indices that we either call HVOL for historical realized volatility or HVOV, historical volatility of realized volatility. And this is where you see what will happen with the options prices. The average 1 month volatility of volatility for NASDAQ for the last 5 or 6 years has been close to 90, about 88.5. So 1 month volatility jumps around a tremendous amount.
Yeah, that's a substantial number.
Whereas the average 3 month volatility is 31.4, and the average 1 year is 9, very, very calm. So when you look at the graphs of these three historical volatilities of volatility, which may serve as a basis for option pricing, you find that there's a tremendous difference between whether you're trading a 1 month product, a 3 month product, or a 1 year product. And it's these numbers that will form the jumping off point or the basis for pricing options on a product such as realized volatility of NASDAQ or an equity index. And yet again, what we would assume is something that we see in VIX options now. It's that the implied volatility of these options on realized volatility will be probably a little bit higher than these historical values that we see, and for the same reason that they're higher for just plain equity options, and that is this risk premium that's built in where the sellers take somewhat of an open-ended risk and therefore charge a little bit for that risk that they assume if they sell a naked option. So the graphs on our website where you see historical volatility of volatility may serve as a jumping off point, but expect to see the implied volatilities of options on our vol contracts and on realized volatility be probably even somewhat higher still than the historical levels that we catalog in our graphs and on our website.
You know, I think it's going to be an interesting period when these products do first list. It's kind of like what we saw with the Euro vol contracts when they first listed. There was this very interesting feeling out period where people were comparing their existing implied levels versus what they were pricing in the realized, and there was quite a dramatic movement and shift as those prices came more in line with each other. And I'd imagine the early going of these, particularly the options on the vol contracts, will be a similar phenomenon where people start feeling it out and get a feel for where they're going to price these, where the market makers get a feel for that as well. And Bob and I were joking about this after the show last week. But it might be a good process for people who are listeners on the show to come in and just pick up a one lot here or there and just see if they can participate in that feeling out process as well, where they can say, hey, I like this level of volatility. Maybe you pick up the future, or maybe when the options come on, you're more of an option guy. You pick up one of the options here or there, or maybe you sell them. Maybe you go to Don's dark side and you want to sell that implied premium on the realized vol. But I think there's going to be an interesting process there. I think our listeners can come in, just try a one lot, I think, and just try it that way to kind of stake their claim on where they think this feeling out process should settle. And I think that'll be kind of fun as a theoretical and somewhat empirical exercise for everyone to kind of have some skin in the game when this feeling out process first starts. I know I'll be very intrigued to see how this unfolds and to see how this equilibrium settles itself between the implied of the options and the realized. And you're going back a little bit, Don, you're right that is one of the nice things about options is that for the most part, the mechanics are the same no matter what you're trading. So you have the underlying and the mechanics of the options pretty much work the same regardless of whether it's lean hogs or realized vol on the NASDAQ. So there is some interesting, there's some nice aspects of that for people who are coming to options and are trying to apply what they've learned to other product classes and other underlyings. A lot of the underlying mechanics of the products will perform in a similar fashion. So you don't have to relearn everything you do every time you change a new product. You don't have to throw the baby out with the bathwater. So that'll certainly be helpful on this front. And while it is, I agree with Tom, it is at first blush extremely confusing to think of it in terms of the implied vol of realized vol. That is the way the cookie crumbles right now. That's the way options work. So there has to be some implied component. I know that's deeply disturbing to you, Don, but you can't get away from that in completely when you're trading the vol and pricing the options here.
No, and in fact, the fact that historically the implieds are somewhat higher than the realized forms the basis for a good deal of the justification for option sellers and for premium sellers. The fact that they are willing, they understand the risk that they take on, but they're willing to do that in some sort of a modified or a hedged fashion, puts, calls, what have you, in order to try to capture that differential that is rather prevalent and rather robust between what actual volatility turns out to be and how the implieds on options are somewhat higher. I also wanted to just pick up on something that you said a little earlier and have one other point to make, and that is that when a new product like this comes out, there surely is a learning curve. And the best way to learn without it costing you a great deal is to first observe and take a look at how an instrument behaves and what the price action is and how it relates to the underlying and to other products. And then when you get your courage up, you dive in, but you do it slowly. So you trade a one lot and you actually own the contract and watch it move both intraday and from day to day to get a feeling for it. And of course, we hope that that's what people will do with this realized volatility contract on NASDAQ, which of course is an equity index. One of the things that I wanted to discuss today, and what I'll hope to do a little bit each show, is to describe some aspect or phase of such trading or price action, and sometimes relate it to something that the listener or the trader may be more familiar with simply because the product has been out there, in this case, VIX futures or ETNs. And today I'd like to just briefly go over something where you could find a divergence between the price action of a realized volatility futures contract with respect to an implied or a VIX-like product. And although the two may resemble each other on occasion and trade in tandem, there are times when the price action may diverge. And I think it's interesting to examine such a time because I'd ask listeners to wonder as to when they own a volatility product, what exactly is it that they want out of such a product? So if you're investing in a volatility contract that settles to the realized volatility of an underlying asset, chances are, without being sarcastic, that if that underlying asset displays a great deal of volatility, you're expecting that your contract is going to appreciate in price. That's what you bought it for. And yet, we find that in the equity world, at least, there is a very strong negative correlation between implied volatility movement, and often even realized, and price action. So that a great majority of the time, if you're watching your CNBC and they put the little VIX numbers at the top and you see it's a day when the market is down, chances are you're going to see VIX in the green and it went higher. On a day when the market is up sharply, dollars to donuts, you're going to see VIX is lower and in the red, demonstrating that inverse correlation. Now, we know that sometimes the futures don't always follow so perfectly what the VIX index itself does, but more often than not, if not the magnitude, at least the direction is the same. So that if the VIX cash index, which you can't trade, goes up, chances are the futures go up, maybe not the same amount, and likewise to the downside. Well, that's fine. You understand that. But the fact of the matter is, on a day when the market would go up, let's say 4% and show a huge move to the upside, I guess everybody in the world would say that's a volatile day. And if I own volatility through a volatility contract, I'd be a little bit put off, I think, to see that I lost money on a day when the market moved in such dramatic fashion, albeit to the upside rather than to the downside. And people shouldn't lose sight of the fact that volatility isn't always a dirty word. You know, if you could measure the brain waves of people when you say market volatility, I think the measurement would always come out that they're fearful and that they see something negative. And yet if the market's up 4%, it's exactly the same volatility as if the market is down 4%, only implied acts in a very different fashion. They call VIX the fear gauge. They talk about when the market drops, how implied volatilities go up because people get scared. And then when the markets rise, they talk about the fear abating and people being less worried about the future, and then implieds drop and come off. But you're likely to see, at least a good part of the time within the calculation or realized volatility period, that realized volatility contracts may act in a somewhat different fashion. So suppose you're halfway through the realized volatility calculation period and we're at about 20, and the logged volatility for the last 10 days has been 20. That's realized, and implieds of options are also at about 20. So a realized volatility futures contract, the vol contract, is being priced at 20. And then all of a sudden, next day, the market is up 4%. Well, that 4% movement is now going to be factored into the calculation. Don't forget, there's a formula involved here. And all of a sudden, that 20 partial volatility from the log data points in the example I just gave might jump all the way up to 27 or 28, and you can't deny it. It's there. It's part of the calculation. Now you say to me, well, yeah, but there's still sentiment. We haven't reached expiration yet. And you just said that when the market goes up, VIX goes in the other direction, implied volatility drops. And yes, it certainly would. Implied volatilities might drop on a 4% move as much as 15, 16%. So that at a 20, you might lose about 3 points. Well, now we have an interesting situation. We have a disconnect. Implied volatility has gone down to about 17. VIX has dropped. VIX futures have probably dropped. But we can't deny that increase in the realized volatility from 20 all the way up to 27 on our 10 or 11-day calculation. And the VIX, the realized volatility, the vol contracts, are going to be priced off of some sort of a blend of the realized volatility from the formula and the implied volatility. And if you've got a 27 and a 17, and you do an averaging of those, well, it's really a root mean square. It's not a linear average. But it comes out to, 22, 23. It's certainly higher. So here's a situation where on a big up 4% move day, you'd likely see VIX lower, VIX futures lower, and the holder of those futures losing money on a very volatile day. And yet the holder of a vol contract will most likely see an increase in the value of the contract as that 4% gets logged into the formula and has a very dramatic and a very profound effect on the pricing. So it may take a little getting used to, but if you are a trader or if you're speculating on volatility and you own a realized volatility contract and you get a big movement, whether it's up or down, you want that to be reflected in the payoff of your contract, and that's what you're going to get with a realized volatility contract. You won't always get it with an implied volatility contract.
That speaks, I think, to the ongoing development and just emergence of volatility as its own asset class these days. And perhaps in the very early days of volatility derivatives, there was a lot of focus on them functioning as some sort of portfolio hedge or some way to offer that sort of hedge to people who are long the broad market and they want to get long volatility as a way to hedge their exposure. And of course, as we've talked a number of different times on this show, all of that use of volatility as a hedge is somewhat questionable, particularly as we looked at the VIX cash performance and the VIX futures performance over the past few months compared to what's been going on in the underlying S&P. That certainly hasn't performed very well in terms of a one-to-one negative correlation. And of course, if you're trading anything on the S&P that is derived from those, and in the implied sense, you're then locked into that S&P skew curve, which is of course exactly what you outlined in your example there, where you're rallying to the upside and your vol's coming off, and you're dropping to the downside and your vol's increasing. And so if you don't want to be locked to that skew curve, you're kind of out of options in that sense. And I think that is why exactly what you explained, that the realized contract as a pure asset class in and of itself really kind of takes that vol as an asset class conversation to that next level where people can come in now. We're seeing a lot of interest these days from people in across a broad swath of the demographics of the option space, interested in vol, not just because it could be a hedge or they've heard of the hedge use case of volatility, but really because vol does exactly what you described. Vol performs on its own, and it has its own independent P&L, which is useful on a number of different occasions. It's useful as a speculative tool. It's useful as a trading tool in and of itself. And so I think as volatility grows and as the concept of volatility as an asset class goes, people are going to start moving away from that concept of using VIX as my sort of broad market defensive tool, or using volatility, I should say, as my broad market defensive tool, and instead using it as its own product the way you would any other independent asset class, and using it to allocate resources here, to use it as a way to gain independent P&L. We all see these days, with so many of the broad asset classes being so linked together, and the concept of, the old school concept of diversifying amongst 12 different equities, and therefore you are quote unquote diversified and your portfolio is safe from a lot of these systemic shocks. We've all seen how that's failed over the past couple of years, that concept. And so the notion of an asset class that truly has its own independent P&L and can react to the upside and to the downside, I think that's attractive and intriguing, I think, for a lot of people coming into this space. And certainly, as people start looking at the NASDAQ product, I think that will be a intriguing concept for them, that they can get volatility in any way, shape, or form. They can get it to the upside or the downside. I brought this up with Nikunj on the last week's episode. Why is no one modeling the quote-unquote tail risk to the upside, or the crash to the upside risk? I mean, it's not as common of a scenario, but as you just pointed out, there is volatility to the upside. It does exist. When you move up, there is no such thing as volatility just vanishing or, diminishing, as we've been trained to see with all of these other implied products out there. And so it is definitely an interesting use case. I think it'll be interesting for a lot of our listeners, particularly when they start trading the product and they start watching how it performs in the real world, what that movement to the up and down and what that can generate for them in terms of an independent asset class. I think that's really an interesting story to watch going forward.
Well, you make a wonderful point there, Mark, and often we've discussed the pitfalls or perhaps some of the problems with VIX, and again, it's not that we're here to disparage a product, but rather to point out the differences in a realized volatility product and what it has to offer, and again, not to beat a dead horse. When you define volatility, and you talk about the standard deviation of the returns, it's without regard to direction. Yet people often lose sight of that and think of volatility as this one-sided beast, when in fact it's a two-sided beast. And we've got a formula. We call it the Vol formula. It's really kind of simple. It's not scary at all when you take a look at it. And nowhere in that formula will you see anything that would distinguish between an up move of 4% and a down move of 4%. It's a move of 4% irrespective or regardless of direction. Well, that's the definition of volatility. Sorry, folks, if that's not the definition of volatility that you're familiar with, but that is the definition of volatility, and there's no arguing it. So we've got a product that's going to deliver that value. It's going to deliver actual realized volatility of the underlying asset. And again, without trying to be unkind, VIX does something else. It just doesn't deliver that. It delivers a forecast. It doesn't deliver anything that's measured by formula. And it delivers a forecast of sentiment. And that's very different from a measured value derived by formula. So we offer an alternative product. We hope people will take a look at it and find the many, many uses for such a product, and run over to our website at volx.us and take a look at some of the papers there that describe the trading opportunities and some of the things that you can do with realized volatility products. Maybe we've come up with a few ideas that you haven't yet considered.
Yeah, and there's no disparagement needed. I mean, it just does something different. And so we, as options traders for years, have been trained to trade in and around that skew curve and to expect that pop to the downside and that nice sell-off of vol to the upside. And that's just the way volatility has performed forever. And if you want that, that skew curve performance, and the VIX is a ideal product for you. If you want something else like we were talking about that does have this sort of independent P&L and this independent movement and these independent characteristics, both to the upside and the downside, then the realized vol is definitely something that I think will intrigue you. And I will certainly, for guys like you and me, Don, who've been trading skew curve for so long, it'll be an interesting reprogramming of ourselves in a way to have a product that actually, for the first time, really counts upside as vol. It'll be an intriguing to watch how that performs, and how when people start coming into these options on the NASDAQ and start trying to adopt approaches like the traditional covered call and whatnot, how those perform in those types of scenarios. It'll be a very different game than what people are used to have been used to in the past.
And I think the part that will be fascinating, as you've just pointed out, is that there will definitely be those periods of time, particularly within the measurement period, that we call the realized volatility period, when the calculation begins, where you have exactly the phenomenon that you've described. Listeners should also understand that these contracts will be listed prior to the start of that measurement period. And during those months, that could be 2, 3, even 4 months ahead of time before the actual beginning of the calculation period, we very much expect that there will be similarities between the pricing of realized volatility contracts and implied volatility contracts, simply because until the measurement actually begins to take hold and the points are entered into the formula, you really don't have much to go on but a forecast of what future volatility might hold. So there are going to be similarities in the beginning when these contracts are listed, and then once you get into the meat and the actual measurement period, you're going to start to see these disparities that we've spoken about. So I think it makes for some very fascinating trading opportunities, both with the single product and with trying to do spreads and arbitrage and trading one product against the other.
All right, and that is going to do it for our mailbag today. We had an extended mailbag, but I think an intriguing one, given all the things there are to talk about these days. It's hard to fit it all into one segment. But thank you for all of you who wrote in. If we didn't get a chance to get to your submissions, don't worry, we'll bring them up on a future show. Just a lot of people are very enthused about the NASDAQ product and what that could potentially bring to the table. And so interesting mailbag today. And now we're going to dive right into our crystal ball segment.
And now we take a look at the crystal ball.
All right, and welcome to our crystal ball segment. This is, of course, the portion of the show where we start that again. And welcome to our crystal ball segment. This is, of course, the portion of the show where we look into the murky ether of the future and attempt to divine what the world holds in store for volatility. And we'll kick things off with our good friend from OptionPit.com, Mr. Mark Sebastian. And what does your crystal ball hold in store for the world of volatility? I'm guessing it says sell at 20.
Oh, yeah. The VIX is a huge sale. And VIX futures are even a crazier sale. I mean, if you want, an interesting trade would be kind of buy SPX straddle, sell VIX futures to hedge the Vega. It'd be kind of, or oversell VIX futures to kind of isolate the gamma. I think that'd be an interesting trade.
I was going to say you might want to ratio that a little bit, but yeah.
Yeah, you'd have to. But Vol's going to continue to come in. It's going to continue to be under pressure. And the way the markets are kind of shrugging off Google, and interesting, Microsoft's the big mover today. Microsoft, think about that. But I'd be a huge
so this is the one and only time where selling premium in Microsoft going into earnings did not actually work out. Microsoft is usually such a resounding meh. In fact, we discussed this on the Option Block show yesterday. And I kind of joked. I said, "Watch, this will be the one time that it does indeed perform out of earnings." And it did. Microsoft up about 5% today. So that at the money weekly straddle, not exactly a screaming sale as it usually is going into earnings.
I think that Bing had 2.5% of internet traffic or something like that.
Yeah, they've been climbing. An incremental increase. Yeah, they've been climbing up on Bing quite a bit lately.
Yeah, well, it's interesting. Somebody was telling me a story that their grandpa uses Internet Explorer and was binging Google. So he typed Google into Bing.
That just sounds wrong on every level.
And then would search on Google. So I'm kind of interested in seeing how many old people are doing that. If you are a geriatric and you Bing Google, please contact us at mark@theoptioninsider.com and let us know about it.
All of your internet research also going on at OptionPit.com. People don't know that, but you are also a student of web traffic.
Oh yeah, I'm exactly. That's one of the things I do. I'm one of the co-founders of Clout.
All right, and thank you for that, Mark. And now, Don, of course, we also like to peer into the murky ether of the future of the Euro Vol contract and see what's going on out there. And given everything that's going on in the Eurozone these days, I don't particularly envy your position here. But by all means, sir, prognosticate for us on the future of the Euro.
Well, Vol is at levels that historically are kind of right where they have been. That's always a difficult time to forecast when you see levels that have been quite below normal. It doesn't take too much courage to predict higher and vice versa. In the front month contract, we're at 1241 for the realized portion, and yet we settled at 1168. So the implied volatility of options is kind of telling us a little bit lower for the remaining 2 weeks, while the Volatility Institute forecast hovers in the high 11s, almost at about 12. So the price looks pretty close. Sometimes it's difficult to look at these numbers without having a feeling for what they actually mean. So rather than make a forecast, I'd just leave our listeners with some sort of a feeling and let them decide what they think. Every day you watch the movement of the euro. It's $1.28 or $1.29. Some days it moves by as much as 1 cent, a full penny. Many days just a fraction of a cent. And what does 12 volatility mean? Well, we've often bandied about 1% a day is 16 annualized volatility. So 12% as a fraction of 16 is 3/4. So 12% volatility, saying the euro has 12% volatility, is saying that you think that on average it moves about 3/4 of 1% a day. If you take the $1.29 and you multiply that by 3/4 of 1%, you get just under 1 cent a day. Get about like 97 hundredths of a cent. But let's call it a penny a day. So in your trading or in your forecasting or in your sentiment, what you're really saying is 12 volatility realistic for the euro going forward? Do I think it might average a movement of just slightly under 1 penny a day? And I'm not going to speculate on whether or not that's realistic or not, but that's the way listeners should translate a volatility number into something that they can experience every day and relate to, just as they might with an S&P number when you've got a 1,300 index and 20% volatility is about 1.25%. So that means that you think on average every day S&P might move around 16 handles in order to justify a 20% volatility. Again, not saying yes, no, right or wrong, but it gives you a way to get a feeling for what the number actually means.
All right, thank you for that, Don. And now that is going to do it for, let me say that again. And that is going to do it for the Crystal Ball segment. That's also going to do it for this episode of Volatility Views. I want to thank both Mark Sebastian and Don Schlesinger for joining me on the show today. And before we go, Mr. Seabass, what is coming up over in Option Pit that may intrigue our volatility listening audience out there?
Well, we just had a webinar on Wednesday on when not to use the VIX as an indicator. The replay is available on our blog. I just want to encourage people to take the silver course, and it's defined as a beginner course, and it is, but there is not a single trader out there other than a guy like me and Mark that won't learn a lot of really useful things out of that course. Andrew and I built it as a way of teaching traders really how to understand what they're looking at, and then to kind of move from there. So take that silver course is what I would say.
And I definitely also would give a plug. I haven't seen it, obviously, but the topic sounds very intriguing. Like you said, the recent webinar you have archived now on when not to use the VIX as an indicator, when the VIX fails as an indicator, I suppose. But that's
it was
an intriguing subject.
I basically walked through how weekend decay works in the webinar and kind of showed people, okay, here's why the VIX falls on Friday and rises on Monday. And you need to understand that when you're using the VIX as a trading indicator.
Exactly. If you don't understand the impact of time decay on that index, then you probably should be trading elsewhere.
Yes. In fact, if you don't understand the impact of time decay on anything, you should probably not be trading options. That's
probably a good point.
Yeah. I mean, but one of the things I found, and this is why I would encourage everybody to take the silver course. I'll have people come up to me and say, they'll tell me how smart they are and how much they know about options. And then I'll look at them and I say, okay, well, I'll tell you what. Let's say, what would you rate yourself on a scale of 1 to 10? And they'll always say 7, 8, or 9. And then I start asking them a couple of really basic questions out of the silver course, and they always get them wrong. And every time they get one wrong, I dock them a point. And then after they get 4 in a row, I dock them down to 2 usually. So most traders out there that consider themselves knowledgeable are probably between a 3 and a 4 on a scale of 1 to 10. Taking this course will get you to at least a 5.
There you go. Get you halfway on the scale. That's Mark Sebastian's pledge to you. If you're not a 5 after you complete the silver course, then your money back. Plus $100 in bonus cash.
Course, we have this challenge. If you feel like you didn't get what you were expecting, we'll buy you the book of your choosing, the option book. We're not going to buy you.
You'll buy me a mint condition signed War and Peace. That's very nice of you.
Yeah, no, absolutely not. And we're not gonna buy you Twilight New Moon or anything like that. But,
now you're speaking my language. There we go. All right, thank you for that. And of course, Don, I don't think you'll be able to compete with the bombshell that Bob dropped on the last show. But anything else that's coming up on the world of VolX.us that may interest our listeners, perhaps any more details or specifics on when these NASDAQ contracts are going to emerge, or anything else that may be interesting over at VolX.us?
I wish I had a date, but again, with all the regulators and the legal mumbo jumbo, we're working as fast as we can to get this product to market, and we really do hope that it will be sooner rather than later. We're in the process of putting something up on the website. It may be another couple of days. In a couple of weeks, we're going to have a guest on from London Financial Studies, a great group that offer some wonderful courses in all sorts of financial subjects, but one of them is in volatility. And they're coming to New York mid-May. I think the dates are the 14th to the 16th of May. Again, we'll have all the details up on the website very shortly. And they're going to offer a 15% discount to all of our listeners on the program, anybody who might be in the New York area. They're offering an extremely comprehensive 3 full-day course on just about everything having to do with volatility measurement and all sorts of econometrics and formula studies and what have you. All of the details of the offerings and the syllabus will be up on the website. So give us a few days, take a look at that. If you're in the New York area mid-May and you really want to learn about the nitty-gritty of volatility, this would be a wonderful opportunity.
Well, that sounds interesting, so our listeners should definitely check that out if they're planning to be in New York and they're interested in volatility, and I'm assuming the latter is a given the fact that they're listening to this show. All right, Don, thank you for that. And, of course, I want to thank all of our listeners out there for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about Vol Contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.